Right. Well, without further ado, these men kind of need no introduction, but what I would like to do is kind of get them all to introduce themselves and their funds and tell us a little bit about your focus and some of the things you've worked on recently.
Sure. So good to be here. We've been backers of Heavybit since the beginning and really excited to watch the community flourish. I'm Ethan Kurzweil. I'm a partner at Bessemer Venture Partners. Been with the firm 9 years. For about 8 of those years have been focused on developer-focused businesses, and we've backed a number of companies that have the same thesis you all have around developers being a path to building really sustainable, functioning businesses. So some of those businesses include Twilio, include SendGrid, include NPM, include Periscope Data, other things like that. I also make consumer investments, invest in video, gaming, future of entertainment, media, things like that. So I'm able to mix it up a little bit. So thank you.
Good stuff. Scott?
My name is Scott Raney. I'm a partner with Redpoint Ventures. We are currently investing out of 2 funds. One is a $400 million early stage fund that focuses on seed, Series A, and occasional Series B. And we have a growth fund that focuses on companies that are a little bit farther along. I personally spend a lot of time investing in around SaaS and cloud infrastructure. I've done a lot in the developer ecosystem, as has Ethan, with investments in Stripe and Twilio and SourceGraph and HashiCorp and a few others. We take a pretty stage agnostic approach to investing and just look for great entrepreneurs and great founders focused on big markets. So
I'm at Andreessen Horowitz. I'm a GP there. The 9, almost 10 years before that, I was actually a portfolio founder at Andreessen Horowitz, so the majority of my experience with VCs is being on the other side of the table trying to raise money. My focus is on horizontal plays in the enterprise. So Andreessen loves kind of core infrastructure and enterprise as a firm. So we backed GitHub, DigitalOcean, Mesosphere, Slack, et cetera, things like that. And so my particular focus is in kind of core technologies in enterprise, especially around kind of developer-led companies.
That's awesome. And just so you guys have a kind of understanding of who's in the audience, can we, if you've raised any form of fundraising, seed, Series A, Series B money, can you just put your hands up? Anyone who's raised venture funding so far? Okay, so that's the vast majority of the audience. If you've raised a Series A, can you keep your hands up? All right, it's a decent number. And if you've raised a Series B, can you keep your hand up? Just one. All right, Fred, we'll call you out later. Good stuff. All right. Well, I wanted to kind of kick us off by just talking about where we think the venture market is at. We had a bumper year a couple years back. 2016 it seems to have been dramatically slower. 2017, according to the numbers, is kind of on pace to be pretty flat, frankly. How have your summers been? Have you been hard at work, putting money to work? Has it been a super busy year for you? How do you think about this year overall?
Yeah, I guess I'll start. I mean, it does feel like last year similar. I think we'd sort of peaked in terms of activity maybe 2 years ago. Overall, it felt like the most frothiest period, and then it has, perhaps slowed down a little bit from then. But in historical terms, still very, very active compared to certainly when I started in venture. Scott's been in venture longer, so can maybe give more of the cyclical context. But there's a lot of money in the startup ecosystem, both at the beginning phases with seed funds and accelerators, a lot of money going to startups, more and more to get folks to a meaningful inflection point. And then at the later stage, there's been a lot of new money that's come in. And so the result is we're really busy because there's just a lot more stuff. But I think the amount of output is kind of holding steady, just a lot more sort of activity to get there.
Scott, is that the same for you? I mean, are you seeing things kind of pick up towards the end of this year or kind of remain steady?
We remain very busy. You got to put all this in perspective, and not to oversimplify it, but I think if you look back to 2007, 2008, it was a pretty important inflection point for what's going on with Silicon Valley with the launch of AWS and the launch of the iPhone, which became these enormous catalysts for starting businesses kind of across the full spectrum. Investment level, by the time 2015 rolled around, was about 3 times what it had been in 2007 and 2007 and 2008. And essentially, I just think it reached what were unsustainable levels. It's not as if the last couple of years where we've seen slight ticks down in terms of investment activity means that we're frankly less busy or there's less compelling opportunities. It's just probably a realistic response to what was this tremendous run-up in activity for a number of years. So,
Yeah. And how about you, Martin? I mean, you sound like you've been busy talking earlier, you sound like you've been busy over the summer.
Yeah, so I don't have the context, but as far as I can tell, there's a tremendous amount of great deals out there, and we've been incredibly busy, and so much so that I had some summer vacation plans, and I put them on hold. So, so I think it's very active and actually very healthy.
And do you see, I mean, do you think that's kind of across every stage? I mean, is that same true at kind of seed stage as Series A? Help everyone understand like where you focus on.
Yeah, so I mean, I like kind of earlier stage deals. That's kind of where I tend to focus. And I would say I get almost a bimodal distribution for the target areas I focus on. So one, man, there is so much kind of amazing new innovation coming out of academia or like people in the industry, and this is kind of seeds and A's and early stage. And I mean, I think, you know, we could have a team of 10 people and not get through all of that. And it's time really well spent, right? Like, I think that there's a tremendous amount of good deal on the new side. And a lot of this is because we've got, you know, I think a lot of really interesting changes in the technology and opportunities. On the other side, there are later stage companies that we spend a lot of time that are, I think, coming off of like the mania of like 14 and 15, where, you know, they got big chunks of funding and that's starting to kind of come up now. And so we're seeing some later stages that are trying to come in. And it feels actually very bimodal to me rather than, I do feel like there's a 14, 15 hump and there's kind of a big kind of new set.
And one of the other things that I think, you know, we going back and kind of looking at the data is, as well as there's a kind of pretty steady pace of activity, one of the things that seems to be happening is everyone seems to be raising more money. You know, I think there's been a pretty consistent trend this year that round sizes have been going up, both at the seed stage, at Series A and kind of Series B. Is that something that you're seeing? Is that something that your firm is playing into or you're concerned about? Ethan, what do you think?
Absolutely, I am concerned about it actually, because in the end of the day, you're measured on financial metrics irrespective of how much money you've raised, right? So you have to build a business that works. And so money can be a catalyst to get there quicker, and that's great. You should spend it all day long. But when you get more money earlier, you know, the discipline around how that money gets spent changes. It's human nature. It's the psychology of you know, scarcity, right? And so oftentimes it's leading companies to get to where they want to get to faster, and that's great. But sometimes it's causing companies to not apply that discipline soon enough. And so we are seeing, I agree with Martin completely. Like when there is this sort of bimodal thing where depending on when a company got started, you can kind of tell based on the approach to go to market and how quickly they've tried to reach various inflection points. And oftentimes it's been a tremendous accelerant, but oftentimes I've seen a lot of ideas that I think may have worked if they had taken more time, but too much money's gone in too quickly, and it can cause a lack of discipline that makes it very hard to recover and build those business fundamentals.
Scott, are you seeing the same thing? I mean, is there too much money going into these businesses?
We're the problem. So
yeah, I don't blame you guys at all.
I know you're not. We're absolutely the problem. The industry raised a lot of capital, kind of assuming that we were going to continue to see this increase in investment activity that had been happening for a number of years, and now that things have kind of slowed down a little bit, tailed down, there's just a massive oversupply of capital, and people are frankly desperate to put it to work. And so, as entrepreneurs, it's frankly, I think, a really good time to raise capital. It's a great time to be able to capitalize your businesses across all stages. But you know, it doesn't mean that I do think that you need to try to calibrate that and be responsible ultimately in terms of how you respond to this desire to put lots of money into your companies at different stages. I would never ever look an entrepreneur in the eye and say you shouldn't take all the money that you can when you can. There are a lot of folks out there on the investment side that are desperate to put large amounts of capital to work and will continue to kind of drive this phenomenon for a long time. What about you, Martin? I mean, how do you think about kind of right sizing the dollars into a business or the size of a round?
I think I maybe have a contrarian macro position on this, which is like, I think there's a reason that money went into venture. It's because like the market is growing massively, and I think like kind of for the first time we can be like, technology is working. It's going after every major industry on the planet. And we're not just talking about the $4 trillion IT budget, we're talking about all of business. And I think it's a great money for it to go into. And like, I mean, it used to be the case for me 10 years ago when I was thinking of startup ideas or talking to investors or whatever. It was like core IT and this and that. And now, man, like half my pitches are agriculture or they're space or, you know, I mean, there's things that we don't normally think about. Automotive, we do automotive investments. And so I always think that you have that kind of this oscillator when it comes to valuations going up and down. But I think that more money means more startups, means more innovation. And like, I feel like the public markets have just utterly failed at creating innovation. I think like the public markets are damped at like, you know, your operating margin is low. It's very difficult for public companies to do massive innovation. So I think that what we do is we invest in like the next generation of entrepreneurs to do that. And so, I mean, I think things are sinusoidal, of course. I don't know if they're taking on too much money. There's a lot of money in venture, but for me, this is positive, and I think this is going to usher in the kind of the next wave of change.
What's interesting about it, just to take, because I agree with some of what you said, but just to inject a little back and forth here, it's possible to be good for the overall ecosystem, like a great thing for society, for entrepreneur, but just for entrepreneurship in general, but not necessarily be good for the individual companies, right? And so I think writ large, it's awesome, right? And it gives us, it makes our jobs exciting and fun and tiring, as you explained, by having to go through lots of innovation. That's great. Like that should never stop. But there is another side to that coin, and so it's a question of you can't really have your cake and eat it too. Like more money is going to cause more activity, is going to cause more spending.
I totally agree. And I think you had the core point, which is right. Like, at some point, if you dance, you have to pay the piper, right? Like for sure. So like, if you're raising money and you overshoot, like more startups will suffer from indigestion than starvation. And like, I think that like markets are very efficient and we'll issue this out. And while we're figuring this out, we go through these kind of like overfunding, and like whatever. And so like, I do think we're going to have kind of all of this messiness, but I do think that markets are efficient. I do think that the reason money is coming in is because innovation and technology is working for the first time. I mean, it used to be the finance guys would kind of laugh at like Silicon Valley, and now it's like every major industry is being toppled. And so I just think this is, maybe bumps to kind of a broader disruptive trend.
Well, I mean, to your point, Ethan, it certainly makes this great for the broader market, great for the entrepreneurial community. Arguably, it makes your lives harder, right? As VCs, you have to deploy this capital. You need to deploy it sensibly. You need to deploy it where you can kind of maximize return. Are you finding that deals are getting more competitive? How do you in an environment where capital is so readily available, how do you really kind of set yourself and your firm apart?
Yeah, no, unquestionably, yes. I mean, more money makes more money competing for the same amount of ultimately, roughly output, output's going up, but a lot more money going in makes our jobs harder. There's no question. But I do take Martine's thesis that now technology is disrupting more and more things. So it sort of behooves you to be more creative. You follow the sort of standard roadmaps of 5 or 6 years ago, and you don't reinvent what you're looking for quickly enough. You're going to be in the most competitive areas with the least exciting opportunities. But you open that aperture, and the developer platforms is very much at the sort of part of this, of something that a decade ago was not a cool place to be spending time, investing, building companies, in the sales process to any of that. Then there'll be that's a way around the competition, so to speak. So I mean, that's how we think about it, and that's and the cycle time on developing new roadmaps just keeps increasing because things happen faster.
Scott,
I've been doing this for a long time, and I can say that the last couple of years have been without a doubt the most enjoyable time I've ever had in venture. The kinds of things that we're looking at in the companies and the entrepreneurs and the opportunity set, it's pretty extraordinary. And so sure, it's more competitive, but I'd much rather be competing tooth and nail for businesses that I think have a chance to change the world than the alternative.
Martine, I mean, A16Z arguably, almost kind of invented this idea of king-making rounds. Of you raise enough money, you can build the market leader in a particular segment. I think it's Ben Horowitz and Mark certainly kind of started deploying large amounts of capital. That's also a big competitive move. Is that something that's embedded into your philosophy or in A16's philosophy, or you still think about trying to rationalize valuations and rationalize the prices at which you get in?
Yeah, so before I became a VC, I had this personal view based on experience that the fundamental characteristic of VCs is they were uncreative. Like, like I basically thought like they did gross pattern matching, and they had like some kind of cliched, quippy view of the world, and they'd follow this formula, and they didn't give a lot of thought. And like, I was totally wrong. Like, the amount of thought that goes into investments, and like whether it's correct or not, like the analysis is behind it. And I've never been in a meeting where we're like, okay, you know, let's do this big round for the sake of doing a big round. I mean, everything is basically like, you know, you've got a bunch of kind of entrepreneur operators in a room. They're like, okay, how much money do you think is needed to win the market? And so, yes, like we definitely place big bets, and we're not afraid to place big bets, but it's because we think that there's product market fit there, and now it's about closing the gap as quickly as possible and creating that moat versus something else. So none of the funding is for the purposes of fundraising alone. It's all because we think strategically this is what a company will use. And so, I mean, really, one of my biggest insights in the last, you know, whatever, year and a half that I've been doing this is how much thought and analysis and diligence goes behind these decisions.
What are the, I mean, you say product market fit there, but I mean, when do you need that for what kind of round? I mean, is it Series A, you have to have revenue and you have to have product market fit, or you have to have kind of go-to-market fit? Series B, I mean, how do you think about the necessary requirements for raising a Series A?
You know, I think this is also maybe just kind of a Martinism, but like if I could, I think I would remove from the lexicon of Silicon Valley seed prime, pre-seed, angel A, B, C. Like at the end of the day, you take on money and you put the money to use, and everything else is made up, right? And like when I was raising money early on, a seed round was like 500K, and then a Series A was 3 million, and now it's something else, and like these things keep changing. And I think the reason it changes is because you've got this kind of this like producer-consumer market where they're trying to figure out like what things mean. Here's the reality. The reality is you take on money and you put that money to use, and then you create an asset, and then people in the future will value that asset and to invest further on. And depending on the valuation of the asset that you have and what you plan to do, there's going to be a decision based on that. And so, you know, like you can have two companies that have raised entirely different amounts of money that, you know, look the same, and you can have two companies that have raised the same amount of money and look entirely different. And so the discussion, I've never heard a discussion, you know, about, you know, what we call the round. The discussion has always been what the company's done with the money they've had and what they're going to do with it. And so I don't mean to play coy. I mean, I think these are reasonable questions, and like we're all very happy to answer the question of what do we look for in companies. I just don't want to be tied down to the seed, pre-seed, supercharged seed, or whatever we call them anymore, because they don't really mean much to me.
Does that mean that it's kind of, you know, there's no longer a kind of Series A firm? If you're a VC, like we don't have a Series A fund anymore. We have a like $5 to $10 million spent.
Well, I think no. I think you can definitely say companies are in different stages, right? You can have a company that's been around for 10 years and now is in a place where an early stage says this is a venture bet. But I tend to think, okay, this is, you know, early stage, you've got a team, and everything else is venture. Or, oh, well, you got some unit economic optics. Okay, so we know what we're betting on. Or, well, wow, like actually we know what the growth looks like. Here's more of a growth investor. So I think about stage of company, and that's a great discussion to have. But I don't think as much about what you called your last round. That just doesn't mean much to me.
I'm with you. I think we should rename them after animals. You know, Series antelope, Series bear. I completely agree. It's an artificial construct, and people are now trying to game it and rename rounds. I've even been in discussions about that, and so if I could take those discussions back from being board member, that would be great.
Well, Scott, are you tired of hearing about seed primes, prime A's?
I agree. It's nonsense at this point. I mean, we just saw a deal that came in and raising a Series A after having raised a $8 million seed. I mean, so it doesn't mean anything. I think really what you have to understand, if you want to understand what goes on in the minds of a venture firm when they're evaluating a project, I mean, you're looking at ultimately how big of a market there is, whether or not a team has the ability to execute against that market, how defensible and differentiated you think it is. And then everything else is really about where you are on the risk reward curve. It's like the thing that we generally think about is does it meet all those criteria? If it does, great. Okay, so how much money then, given the risks associated with what we think, how much money are we willing to put at risk in a company at that stage based on those risks? And that is really what we go through. And so we kind of drop what we think are you know, the history of the company. We take a look at where it is now and whether or not we think we can generate the kind of returns we want based on the risks that we're seeing. So,
a good question I always ask a discussion about a company, or usually to the entrepreneur, is like, all right, where does this get you?
Yeah.
Like forget what you're going to spend the money on, which is, that's obviously something to go through as if you're going to invest, you'd want to know. But forget that. Where are you going to be at the end of it? And is that cash flow? You're going to be a cash flow positive company, and this last money you're ever going to raise, does that mean you'll have tackled product market fit, you'll have scaled, you'll have done this, and is that a place you want to be? And is that exciting and worthy of the amount of capital being asked for? And that, I think that is the best way I know of to frame the, what series and size round this is, because, it's been said, there's no guidelines anymore from nomenclature.
Yeah. So I agree, and I think that there is an asymmetry in this market, though, that's actually really worth understanding, because this is the one area in venture where you don't have a totally open market. So if you believe what I just said previously, you believe that, listen, you have a startup, you create an asset, that asset has a certain value, and people buy a percentage of that value. You've got an open market, so if it's worth a lot, people will pay a lot, and if it's worth less, people pay less. And by and large, that's true, which is why it doesn't really matter what stage you are. But here's the one asymmetry that changes this, which is why you need to really think before you take on too much money and overvalue your company. And the asymmetry is the following. It can be very damaging to devalue something in this market because of preference structure. So in normal markets, you're like, oh, it used to be worth $5, but now it's worth $1, whatever, we go ahead and trade it. But in venture, because of the way preference works, it can hurt the company. It's certainly almost always common stock that gets squeezed. It creates bad relationships on the board and things like that. And so, I would say generally think about, when you're raising money, you really want to raise the amount of money needed at a valuation needed to get the next stage of funding, and that's very important. And if you overshoot that, that's when you get into the failure scenario. Does that make sense? So mostly you can view this as an open market with that one pretty significant caveat, and which is why I do think you need to worry about.
Building off that point, certainly when I started in venture, it was not uncommon to see down rounds, cram downs, restructuring of cap tables. These days, I see more venture investors walking away, because it's a lot of hard work. As Martin says, it's kind of painful to restructure the preference stack. It's kind of painful to cram down common shareholders. It's kind of painful to rip out management, etc. Is that a pattern that you've seen? Or
yeah, I definitely feel like it's less common now. As we talked about before, there are more interesting companies that are emerging. Obviously, I think about where I want to spend my time as an investor. I could spend my time trying to fix up, work on fixing up something that needs a lot of work here, or I could start, fresh here. And that is certainly part of the calculus, and a lot of times you're fresh. But obviously, we have a portfolio, and a number of times, some of our companies have raised more money than maybe they should have, or raised at valuations that weren't really sustainable or underperformed relative to a plan. And so we spent a lot of time working with those companies to help kind of shore things up and right the ship a little bit, just from a cap table standpoint, to make sure that they're in a position to raise additional capital and to succeed going forward. But I think generally now, I would say overall, it's harder for companies that run into that situation to be able to succeed over the long run, and particularly because it's such a fluid labor market right now. Once you run into situations like that, it's very difficult to go to your employees and say everything's going to be okay. A lot of times they're going to be like, well, I've got this offer from Facebook or Google or GitHub or whatever down the street. Maybe I'm just going to take advantage of that opportunity now. So
it's kind of a shame a little bit, because there are companies out there that have done great things. Just because they're not worth $1 billion, they're worth $700 million. That's pretty good in an absolute sense, but human psychology is to anchor. And so when you come down from an anchor, it's hard. It's really hard to say, that we were off, we overshot, we didn't hit our plan, the things that Scott said. And we will dig into some of those situations often. But to Scott's point, and Martine earlier, it's a hard conversation. It does fray relationships, and it doesn't often make you popular. But a lot of times you think that you step back and you say, this could be a great company. We're not willing to value it where it was, but still a great company. Stocks are bought and sold in the public markets all the time for less than they were worth yesterday. That should be okay, but it has evolved such that it's not common.
There are dozens of companies out there right now that are avoiding this problem because they raise so much capital they don't need to face it.
Right.
So it'll be interesting to see what happens.
Yep.
When does the music stop? How many months, years have we got before capital supply dries up and people have to face the music?
It's never going to be one big apocryphal period of time. It's happening. You're little by little. A number of these companies have raised big valuations on models that probably didn't warrant it. But as we've said, it doesn't mean they're broken companies. It doesn't mean that they're not interesting and exciting companies. It just means that at one point somebody was willing to value it higher than maybe it would be today.
Do you think it means that the founder's probably no longer likely involved?
Not necessarily.
No. In fact, a lot of times it's the founders who are going to be the most important people at that time. There's no one who will ever value what a company's doing more than the founders. And when the going gets tough, it's really the founders who often are going to be the ones who are going to be willing to pick up the slack and do what's required to actually make sure that the company can be successful over time. So,
but I mean, as companies are raising more and more money, I mean, the pressure's going up, and you have to go from being just a founder with a good sense of product and a good sense of market to someone who can, manage and lead an organization with hundreds and hundreds of people.
Sure.
Like, how do you have that conversation with founders about, are they the right person to be leading this company, whether it's a down round or just, taking this company to the next stage? No one wants to answer that.
No, I'm
will.
actually happy to. So, I think one thing I learned over the last decade of, when I left the organization I was running, it was 1,200 people, and it started with 2 people in an IKEA desk and badly dressed PhDs and the whole thing. And I believe you can kind of make any organizational structure work. I don't think organizational structure is a big deal, and I believe you evaluate companies by the executive team, and no single person is an executive team. And so the discussions that you have around about leadership are about the team, not necessarily about titles or organizational structure. Does that make sense? And so if anybody is like, oh no, I don't want to extend my team because I can do everything, that's clearly a bad position. On the other hand, it's very often as things scale that you need to kind of refresh team members or kind of increase the scope or up level or whatever, and that's a pretty straightforward discussion. And so again, I tend to view this is a team game, including the board. The executive team is a team, and you do have to evolve it over time, whether that's through coaching, whether that's through hiring, or whether that's through moving. And I'm way less fixated on organization and titles.
It sounds cliched, but what I try to do is talk about it going in before there's any formal tie there. But it's just to be super direct right away as soon as you have a feeling. And this can be controversial because you may say, well, it looks like this part of the organization's not scaling, or this, you're not handling this situation well. And that can be an awkward, uncomfortable thing to tell a founder who's trusted you to have their back and all those things. But I find, and it's not fun. It's not the part of the job we enjoy. But I found that just not waiting on any of those thoughts just gives you ultimately a lot more credibility and a lot more trust later. And usually, usually there is agreement. I can't think of any situation where even having to deliver some news like that or say, hey, this needs to be taken care of, or you're not doing this, you're missing something, where at the end of the day it was awkward or wasn't fine because may take some time and may take time to surface, or I could be wrong, but ultimately I think you can only do your best of surfacing the truth, and if that's uncomfortable, so be it. But I think the alternative is worse, of letting something fester that's ultimately going to be damaging.
Maybe I've been lucky, but I've never once had a situation where a founder didn't come to me and basically say, I think I need to be replaced. It's usually... I think you've
been very lucky, Scott.
Yeah. I was frankly, some of the guys here that started Heavybit were people that I worked with in a situation who had Heroku, who had said, we need to bring on a CEO. As I said before, the kind of founders that we're backing are really invested in the mission of a company, and they want it to succeed. And it's more often than not, they're going to be willing to, they're going to acknowledge maybe their deficiencies in certain areas, particularly as companies scale, and usually that's when they're raising their hand and say, hey, can you help me find somebody else to help run this business? I think the one thing I would tell you, the most important thing that you could ever ask for in a relationship with a venture capitalist, without a doubt, is complete and honest, brutal transparency in all communications. And that needs to be bi-directional. It needs to be, you should be looking for investors who you feel very, very comfortable having open and honest conversations. They feel like they have your back and are kind of bought into the mission of the company. Because when you have those kinds of relationships, you find that there never really becomes a time where there's like this massive disconnect. It generally is a more organic thing where you guys ultimately, as a group, arrive at similar conclusions. So.
Policy of radical candor for everyone around the table.
Yeah, it needs to be both ways. Believe me, I've gotten a lot of feedback from founders over the years.
Well, I mean, we talked a lot about how important management, how important the founding team is. And Scott, earlier you kind of mentioned, VCs are kind of assessing the management team and the executive team, and also kind of the market. The one thing that we've really not touched on is the kind of the fundamental metrics, right? I mean, as much as someone says, we like this market opportunity, it's a large addressable market, we think the founders are talented or the executive team is high quality. In my experience, VCs want to see the numbers. Like, what are the numbers that you want to see? And I mean, I'll call on you, Ethan.
Sure.
I mean, I think Bessemer is arguably one of the more metrics-oriented funds out there. Kind of keen eye for
Our head of marketing is wincing, by the way.
Yeah.
But anyway,
as well
we do
being
like
a
numbers.
visionary fund as well,
Thank
looking
you.
for market leaders
Pull it
like
back.
Twilio.
Pull it back.
And,
There we go.
Yeah.
But obviously numbers are important, right? Are numbers important to you?
I'm going to give the answer you didn't want me to give, but it depends.
Sure.
So I do like, as a firm, I didn't give this part of the intro, but we're stage agnostic. So we'll do from an early stage to a more like a growth investing. And in growth investing they are. And then they're, before that, hopefully you're tracking them so that you can present well to a growth investor or a buyer or a, anybody that's looking to value a business. So, what we tend to do, and, we're getting involved at the Series A. I broke the rule that we agreed to 10 minutes ago.
The antelope.
Series, elephant. We'll tend to talk with the entrepreneur, pretty directly about like, okay, how's this business going to be measured? What are the important metrics for us to track? And there'll be, usually there's not a ton of debate about that, but we'll talk about different KPIs that we can measure, and then help figure out the best way to measure that. And usually it's the things that you would imagine. It's like the effectiveness of their go-to-market activities. How much are they spending on selling and marketing the product, and how much are they getting back in terms of revenue and margin from their customers. So there's a number of ways to measure those things and ratios to use. But that tends to be sort of the basic equation of how businesses function. And then obviously the other thing we focus on very heavily, especially in developer-driven businesses, is churn and the stickiness of customers. How are customers voting in terms of their usage and paying for the product? And so there's sort of churn metrics around usage and churn metrics around revenue, and we tend to encourage founders to look at both of those things.
Is there a kind of red flag for you? I mean, if churn is above a certain number or below a certain...
Well, it just totally depends on what the type of business is,
Sure.
and what the model is, and who the buyer is, and so we don't have a red flag, but you'd want to know that the activity you're putting into selling it comes back to you in terms of the amount customers are, how many customers you get, how much they're paying, and how long they stick around. So you'd want to sort of look at those ratios. You could have a business become involved in a business intercom that has a lot of small customers use it, and a lot of those customers don't make it and churn. There's churn at the low end of the business, and that's fine. That's part of the model. The model assumes that, and that's okay. So.
Martin, obviously you were saying earlier, kind of the meta-analysis that you put into these deals. I mean, are there particular things that you're looking for say a Series A or a Series B investment?
So I'm an early stage dude and I'm an enterprise dude. Like, that's kind of my thing. And the nature with how these are being evaluated is changing dramatically and has over the last couple of years. So maybe I'll take a second to describe how that is. So it used to be the belief that if you were a consumer investor, invested in consumer companies, you'd look for the phenomenon, right? Which is like, nobody could really predict what 19-year-old males in this part of the country would like or not like, and so you just kind of wait until you had a growth graph and then you would invest, right? And the reason for that is because it's so difficult to predict consumer behavior, you really are a numbers person, investor. And then the belief on the enterprise, especially in the early stages, is you could actually do diligence on technology, and you could actually do diligence on product market fit by calling customers and so forth, so you could actually de-risk that way and invest in the early stage. And so if you actually look at like traditional consumer behaviors, I mean, like, man, they use so many acronyms I don't understand, and they've got very sophisticated analysis, and they apply these analysis. And then, the enterprise folks, did kind of roll up the sleeves and did a bunch of diligence. But now, because the developers are so dramatically changing buying patterns, and because open source is starting to replace lead gen and marketing, like, we're starting to view this differently. I mean, it turns out, like, if you don't have the developer ear, it's much more difficult to sell. And so, I mean, I would view that the investing community in the early stage of the enterprise is starting to try and create the same level of discipline and understanding that the consumer guys have had, but we're probably 5 years behind, right? So like the equivalent of MAUs and DAUs and all this other stuff that they do, we're trying to apply to it. And so, I mean, we look, for example, the investment team that I work on, well, we very much look at, what sort of adoption is, what sort of traction, is there a phenomenon there, how many developers are using it? But we can't just look at the phenomenon itself, because there's a lot of pitfalls with open source, right? Like, okay, like, are you under the cannibalization bogey, right? Is like the open source going to cannibalize your business model? Is there a mode? Is this going to fragment? Is this a large market you're going after, et cetera? And so I can't give you a clean answer, and I don't think anybody can, about like, there's the magic set of things you can do. But I can tell you that more and more we view the enterprise infrastructure market as, have you created a phenomenon? And then we do the analysis, is that a monetizable phenomenon?
Scott, are you going to give me a clean answer for the 5 metrics that every developer company needs to have?
No, no, I'm not. I mean, I say this over and over again, and it's like a broken record, but it's a little bit along the lines of what he was saying. But first and foremost, particularly if you're going after developers, it's about winning over hearts and minds. And that is really, it doesn't matter what numbers are that you have. If you haven't done that, like if you have a small group of folks who are using this in some way and you've been able to monetize them significantly, that's interesting. But what's much more interesting is that you've created, as you said, a phenomenon. You've really have captured those hearts and minds, because it's based on our experience. We've seen time and time again the ability to actually then leverage that to actually build businesses is important. I mean, we could talk a little bit more about later. It's a different question, but like, what kind of business model is the most interesting? But it begins and ends there, really, for us. It's funny, like, an early stage company comes in and they've won over hearts and minds, and we're going to be excited. A growth company comes in, they still haven't really kind of figured out monetization fully, but we feel like they've won over hearts and minds and they have a significant amount of potential. Then we're going to be fine with that too. So.
And we'd love to talk more about that. I mean, maybe now is a good point just to say we'd love to hear your questions as well, and we'll keep an eye out for anyone who's got questions for the audience.
Edith as well.
Edith, why don't you kick us off?
Basically, the way I look at it is, it's like this winning over hearts and minds. It's like a delicate flower for a period of time, and really what you don't want to do is to lose faith with the people that are engaging with your products at some level by immediately making it feel like you're trying to monetize them or build a business on top of them. So I've always said, for a period of time, I think it's really important to build community and to try to drive adoption as broadly as you possibly can. But it's really incumbent upon the companies to build product strategies which allow you to do that, yet monetize over time, like to figure out ways to deliver value and to get as many developers or users as you possibly can, but then to have in your back pocket a set of capabilities that you can layer on over time to your users. And many of them often will come to you and say, these are things that I need. And when they do that, that helps inform the product strategy, but kind of layering that over time and monetizing. I would say it's easy to say that. In practice, I've seen many companies who who are clearly like waiting too long and are like kind of lose sight of the ability that ultimately you do need to build a business here. And so there are plenty of examples of companies that have gone out and built massive amount of traction, but they really never left themselves enough room to eventually build a business, or frankly waited so long that it was difficult for them to change the nature of the relationship with their users at some level. And so there's a fine line here, but if you're a seed or Series A company, what I would tell you is the most important thing is to treat your relationship with your users and developers as a delicate flower, and allow it to bloom and blossom before you try to kind of grab onto it too tightly.
Martin, you mentioned challenges around kind of building open source businesses or business off the back of open source. Is that kind of balance between obviously the vast majority of people who are going to be using free open source software versus commercial open source or SaaS version of your open source? Is that even more acute in open source, or how do you think about trying to turn an open source business into something that's actually commercially viable?
Yeah, so I tend to segment this into marketing and then sales around a product. And I think people tend to often conflate these things. They kind of conflate open source with product or sales or something else. And so it seems to me that the way that it's shaking out, if you look at the companies that are engaging this way, which is, it used to be the case that if you're doing an enterprise company, you'd start your enterprise company, and then you'd do a direct sales, and you'd go talk to the customer, and then that lead either came from the sales team or maybe from a lead gen team, and then you sell to those. And the reality is now is that front part of getting in the funnel and kind of aiding that sales, which has typically been a product marketing role and a lead gen role, that's been replaced by getting the attention of the developers. And so that to me is that is a specific function, which is how do you get the credibility, how do you get the top of funnel, how do you engage in the developers? And it should be viewed that way. Now, if you think that is your company, then you basically bet your company on a marketing engine, which is always a bad idea, right? And so I think you need to be very honest and very clear that marketing is not sales. And if you give away the thing during marketing that you're going to sell later, nobody's going to want it because they already have it. And so I would encourage all of you, as you're coming up with your strategy around developer adoption and around open source, to realize that outreach is very important. Getting that top of funnel is, but you have to do it in a way that doesn't undermine the following product. And I think 5 years ago we used to think that it's very difficult to do around open source. We have so many proof points of it working now. I think there's a number of models that do work. I would just be very clear about them up front and not conflate adoption with the ability to build a company.
I do think there's a disconnect sometimes we see with certain companies who are building around open source, and they confuse momentum within the open source project with momentum at the company level. And those are two very different things. I mean, I think it's a little bit a different way of saying what you're saying, but particularly when you don't own the open source project yourself, right, as a company. And so I just think, just an observation and kind of along the lines you're saying, I think it's really important to understand, as a company, who your users really are, right? So,
I mean, adoption's one thing, but I mean having millions, tens of thousands, hundreds of thousands of registered developers is not necessarily a good measure of whether or not they're engaged, right? Whether or not they're actually doing something kind of material with your product. I mean, do you care about engagement as much as you do adoption? If so, how do you measure that?
I think that's right. I mean, it can be. It certainly can be a measure of a good thing. It kind of depends on whether that's going to lead to something that is in itself monetizable. So if you have a lot of people using your product for free, that can be great. It can be often better for a company in terms of the value it creates to have a bunch of that happening, as long as that leads to some people paying you for something, right? And so with open source, that's often the case. With products where there's a sort of segmentation of the users, where there's some that are very, very small teams that really couldn't afford to pay you much and would rather use a product and help evangelize it for you, that can be a great form of marketing. That can be useful for all bunch of different reasons, as long as it leads towards something. And so that tends to be the higher order bit. I think measuring the health and activity of a developer audience is hard. I mean, it really goes to what does the product do, and are the people doing that with it? And so just signing up for something, it's probably not the right measure. Using it in the way it's intended is the right measure, and that's what you need to get to.
I don't think you want to sell to developers. You want to sell through developers. And it's something that we've said a lot. I mean, I still think developer budgets are really constrained, and I think it's very difficult to build big businesses that are trying to extract dollars out of at the individual developers. There are exceptions to the rule. I mean, clearly GitHub and others, which are, that's actually morphing a bit, but there are certainly exceptions to the rule. But generally, it's what you want to do is leverage all that momentum within the developer community to actually be able to then pitch business value to parts of organizations. And I think Twilio's at SendGrid and Stripe and a number of things. I mean, lunch historically, Edith and I were talking earlier, it's a great example, another one where you're pitching this business value, but obviously you have to win over the hearts and minds of the developers to do that. So.
I think the first step towards that, it's a really thoughtful question. It's a lot easier to talk about than to actually do it in practice. But I think the most important thing is to figure out what are the near-term set of milestones that you're hoping to achieve. Like, where are you hoping to get to on the current set of capital? And then, so then you can sort of reverse engineer from that, okay, what are the things we have to do to hit those things? And I don't want to say everything else is noise, right? Because there's other things you have to do to run a business. And you want to be so focused that you're not managing the health of the community and other things that may not be a direct kind of goal for this next period, but try to minimize as much of the other stuff as you can and spend your resources on what matters. And so if you're taking in a round of capital to scale the go-to-market, the sales, the marketing, then that can be the primary focus. And then at the same time to evolve the product to address X, Y, and Z, then that's a focus. And so those are the things that you would want to spend money on. Now that's like a very sort of simplistic framework for it, but the money you're spending just because it's like part of a business, I would ask the question, why? Like maybe we should spend that over here. Because as entrepreneurs, you should never stop taking risks. And so my framework would almost preclude it, right? If you just spent money on the exact things to get to the next milestone and nothing else. And so, but I think you have to have anything else you do, you'd have to have the conviction that this is why I'm doing it. And it's like a higher bar. I'm going to do this other thing. I'm going to build this skunkworks thing over here. And here's why. But like, I really believe as a founder. And anytime a founder really believes, that's something you shouldn't get in the way of. And so, I like where you were going.
Yeah.
Yeah, maybe I can tease apart the question a bit. And by the way, I totally agree with what you were saying. It's really hard to think about, especially as an entrepreneur, this question, right? So maybe this mental model will help. And it's kind of the one that I use, because I was always kind of curious about, like, okay, like I've got the stage in the company, why don't I just take, N hundreds of millions of dollars and call it a day, right? The reality is you can almost view every funding event where so there's a black box that you're throwing money into, and hopefully what pops out on the other side is going to be what's needed to bring you into the next risk category. Does that make sense? So you're moving your company between risk categories, because risk categories affect different types of money, look different types of things, right? Like, maybe it's team, and then it's product market fit, and then it's unit economics, and then it's growth. Does that make sense? And there's a natural law of physics for how you can, how quickly you can apply money and what you can do with that type of money. So for example, if you're like, we've got product market fit, we believe our unit economics are there, then you put in money to scale the sales team. There's only so fast that you can deploy that, right? There's only so fast that you can actually deploy that. But there's a certain minimum that you are required to actually do that. So then you ask the question, well, okay, what happens if I underfund it? If you underfund it, then you don't get quick enough to the next stage. So now you've sacrificed the ability to enter the market. So what's the problem of overfunding it? The problem with overfunding it is you only have so much line of sight to that next stage that if you overvalue your company or you bring on too much money, I mean, the reality is for the first N years of a startup, all of your risk is really funding risk, and you're jeopardizing your number one risk, which is funding risk, by taking on too much money. So I would, if I were you, I'd discretize, never mind seed A, anything else, I'd discretize your job. Your job is to move your company to the next risk stage, to attack the next type of risk capital. Try and understand how much money is needed to do that. Does that make sense? Don't overshoot, because, like, seriously, you will have to pay the piper in the future, and then get it to that point. Does that make sense?
So I guess we would generally counsel the rule of 40. I think it's a good measure, but it's generally companies with 50 million in revenue and above is when you might, in the early stages, right, you're gearing much more of your activity towards product development, and you don't have a lot of revenue yet, and so it would look way out of whack if you applied it. And there's a danger to applying that too early, because you could cut off. It could lead you to make suboptimal decisions for the long term. And even companies with tens of millions or 9 figures of revenue, it may still not be the right way to look at it. That's the beauty of being a private company, is you don't necessarily have to be measured that way. I think at a certain point, you'd want to apply that balance. And rule of 40 is sort of a good trick, but not the only factor.
I got an email yesterday from an entrepreneur that's raising the company's 6 months old, and they were asking if we would be interested in investing a couple $1 million because they're looking for a few venture firms to put their name on their cap table before they go out and raise a $250 million ICO. And I forwarded that to my partners and saying, this is not going to end well.
So you didn't invest?
I think the ICOs, it's a really interesting phenomenon. I think there's actually a lot of value and merit associated with it when used appropriately, but it's like the Wild West out there right now, and I think that you see a lot of individuals who aren't accredited investors who are able to commit significant capital into these companies without really any visibility into the companies at all. I mean, I'm not one that likes to say this, but I think this is something that probably needs to be regulated more tightly, and I think if not, it actually has an opportunity to really do more harm than good. But under the right circumstances, done appropriately, I think it could actually be very, very powerful, in particular for companies that are, cross-border transactions, things like that. But, I think there's going to be a lot of pain between here and there.
As a purely theoretical matter, I love the idea of a blockchain. The problem has been that a lot of the companies raising ICOs now are disconnected from what blockchain is really useful for. Giving you a unit account so you can earn it or buy into it, and pre-selling an actual item that is going to be traded in that way. A lot of people are just using it as an alternative funding mechanism where it doesn't have that characteristic of sort of a networked model, like a file sharing system where you participate by giving storage space or you buy into storage space. That really makes sense to me. A lot of these don't have that, and that's where I think it won't end that well.
You guys just did one, right? I mean, you did the...
Yep. A16Z's on a couple of Bitcoin or crypto ledgers, right?
Yeah. So Chris Dixon is the partner the general partner that focuses on cryptocurrencies. And so, just very quickly from my perspective, so I love cryptocurrency. I love the idea behind it. I think it's fantastic. I've been convinced over time that the primary innovation there is a network building one, which is there's been actually very few networks actually created by the internet, right? I mean, there's been, and by the way, Chris has a blog post which really describes this well, but so you've got, Amazon, you've got LinkedIn, you've got Facebook, you have a few networks. And if you look at kind of the way that cryptocurrencies are being very disruptive, it's a new mechanism for creating a network where the individuals of the network are invested for that, right? That's very, very disruptive, and I think there's going to be a lot of change. But the problem is my concern on the enterprise is the things that make cryptocurrency so interesting are almost all in the consumer space, and it's not super clear that they actually apply to the enterprise space, like this network effect thing, the fact that you've got a distributed ledger versus a centralized ledger. So it's not super clear to me how it applies to the enterprise. And being a strictly enterprise-centric dude, I don't have broad opinions beyond that. Yeah.
Don't raise venture capital.
Yeah. Be nice to your venture investors.
If I have, it's funny. You get asked to give a kind of. It's really hard to give talks and not say cliches. It's just this is the truth in Silicon Valley in general. And I spent a long time thinking about okay, if I actually had one piece of advice that I would give to entrepreneurs, what would it be? I basically got the snot kicked out of me for 10 years, and every year we thought we were dying, and did the whole thing. And in the end, it's very difficult to distill that into anything that's kind of not form fit to my personal arc, except for maybe kind of one thing, which is I think the most important thing in being part of a startup is to take the long view, and it's almost the most difficult thing because you as an entrepreneur or aspiring entrepreneurs or those as operators working in companies, you're jacked into the nervous system of what you're doing, and everything hurts, man. Every time somebody leaves, every time you lose a customer, way more than if you're in a big company. And you feel it, and it's super raw. And listen, this is piped into your limbic system. And so it's very, very difficult to step back and take this macro view that, you know what, like everybody else is going through the same Odyssean saga you are, and they're all getting the snot kicked out of them too. And like it's all being crammed in this kind of small, 5-year space where you're going to be simultaneously cowardly and brilliant and neurotic and skillful and everything else. And so I do think it's very important to be able to step back and realize that this is kind of how the journey goes, and just being consistent across that is very important. As far as what I've learned as being a venture investor, which is like, and just very quickly, I knew I wanted to be involved with entrepreneurs and kind of this creation of phenomenons, and I gotta say, man, it's such a privileged position because the entrepreneurs are so rad, like they're so great, and so I'm just super happy that I did it.
Well, I think that's a great note to end this panel on. But I hope you all join me in thanking Martine, Scott, and Ethan. Appreciate you coming out.
Thank you.